There are moments in history that seem completely ordinary while they are happening. No breaking news alerts, no emergency broadcasts, no politicians standing behind podiums admitting that the rules of the game have changed. Life continues as normal. People go to work, pay their mortgages, check their retirement accounts, and assume tomorrow will look much like yesterday. Yet beneath the surface, something far more important is unfolding. A financial shift begins quietly, almost invisibly, until one day people realize that the money they spent decades earning no longer provides the security they thought it would. The most dangerous financial events are rarely the ones everyone sees coming. They are the ones hidden inside numbers that appear perfectly normal. For decades, governments around the world have relied on a simple formula. When spending exceeds revenue, they borrow. When borrowing becomes difficult, they create more money. At first, this appears manageable. Economists explain it away. Markets remain calm. Politicians assure the public that everything is under control. But history shows that every debt-driven system eventually reaches a point where mathematics becomes more powerful than political promises. At that moment, leaders face a choice. They can accept painful adjustments immediately, or they can postpone the pain by weakening the value of the currency itself. Almost every government chooses the second option because it appears less visible in the short term. The problem is that invisible pain is still pain. Today, the United States finds itself facing debt levels that would have been unimaginable only a generation ago. Trillions have become tens of trillions. Interest payments alone now consume a growing share of government spending. Every year, more borrowing is required simply to maintain existing commitments. This is not a partisan observation. It is basic arithmetic. When debt grows faster than income for long enough, confidence eventually becomes the most important asset in the entire system. And confidence is difficult to measure because it remains strong right up until the moment it begins to disappear. The first sign rarely appears where ordinary people are looking. It begins in the bond market. Government bonds are often described as the safest investments in the world because they represent promises made by sovereign nations. But investors are not charitable organizations. They demand compensation for risk. As debt levels rise, lenders begin asking for higher returns. Bond yields move upward. Financial commentators describe it as a routine market adjustment. But beneath that technical language lies something much more significant. Rising yields are the market's way of questioning the future. They are a signal that investors require more reward because they perceive greater uncertainty. Once this process begins, the effects spread through the entire economy. Higher borrowing costs affect governments, corporations, and households simultaneously. Credit becomes more expensive. Financing becomes more difficult. Growth slows. Yet governments still need to fund their obligations. This creates enormous pressure on policymakers to support the system through monetary expansion. More money enters circulation. More currency units compete for the same goods and services, and slowly, almost imperceptibly, purchasing power begins to erode. This is where the second stage emerges. Most people think wealth is represented by the number displayed in their bank account. In reality, wealth is what that number can purchase. Imagine spending 30 years building savings through discipline and sacrifice. Imagine doing everything correctly. Then imagine waking up one day to discover that while the number in your account remains unchanged, the cost of housing, food, healthcare, education, and energy has risen dramatically. Nothing was taken from you directly. No one emptied your account, yet your purchasing power has declined. The effect is identical, even though the mechanism feels different. History provides countless examples of this process. Different countries, different cultures, different political systems, but the pattern remains remarkably consistent. Currency debasement rarely arrives as a sudden catastrophe. More often, it arrives gradually, enough that people adapt. to each step without recognizing the larger trend. Prices rise, wages eventually follow, markets fluctuate, life continues, but beneath the surface, value is being transferred from those holding cash and fixed claims toward those holding assets linked to real economic resources. The next phase is particularly deceptive because it creates the illusion of prosperity. Asset prices begin rising. Stock markets climb. Headlines celebrate new records. Investors feel reassured. Retirement accounts appear healthy. Many conclude that earlier warnings were exaggerated. But there is a crucial distinction between nominal gains and real gains. If an asset rises 20-1 while the purchasing power of the currency falls significantly, the apparent profit may be far less meaningful than it appears. People often mistake a rising number for an increase in wealth when, in reality, they are measuring value with a ruler that is shrinking. This phenomenon has repeated itself throughout financial history. During periods of monetary expansion, stocks often perform well because companies own real assets, generate revenues, and possess pricing power. Investors see green numbers and feel protected. Yet the true question is not how many currency units an asset is worth. The true question is how much purchasing power that asset preserves over time. That distinction becomes critically important during periods of financial transition. While investors focus on stock market performance, another sector quietly faces growing pressure: real estate. Many families view their homes as the foundation of long-term financial security. For decades, this assumption has often been rewarded, but real estate depends heavily on debt. Most buyers rely on mortgages. When interest rates rise, monthly payments increase dramatically. A house is not valued solely by its physical characteristics. It is valued by what buyers can afford to finance. As borrowing costs climb, affordability declines. This places pressure on prices even if demand remains strong. Consider how many retirement plans depend on home equity. Millions of people expect to sell larger homes, move into smaller properties, and use the difference to support retirement. It is a reasonable strategy under stable conditions. However, that strategy depends on future buyers having access to affordable financing. When mortgage rates remain elevated, the pool of qualified buyers shrinks. The home itself may not have changed, but the economics surrounding it certainly have. Financial plans that appeared solid for decades suddenly reveal dependencies that few people previously considered. As confidence in paper assets weakens, attention gradually shifts toward tangible assets. This is a recurring pattern throughout monetary history. Investors begin seeking assets that do not rely on promises made by governments, banks, or financial institutions. Precious metals, commodities, productive land, energy resources, and other real assets attract increasing interest. These assets derive value from their physical existence rather than contractual obligations. They cannot be created with a keystroke. They cannot be printed into existence. Their supply tends to be constrained while demand remains persistent. This does not mean every tangible asset automatically succeeds, nor does it mean financial assets become worthless. The reality is more nuanced. What changes is the relative preference of investors. During periods of monetary uncertainty, the market often rewards scarcity, utility, and permanence. Assets connected to those characteristics tend to preserve purchasing power more effectively than assets dependent entirely on confidence in future promises. Perhaps the most important lesson from history is that these transitions rarely happen overnight. People imagine financial crises as sudden collapses, but many of the most significant wealth transfers occur gradually over years. By the time the majority recognizes what is happening, much of the adjustment has already occurred. The opportunity is not in predicting an exact date or triggering event. The opportunity is in understanding the structure while there is still time to adapt. This is why fear is not the appropriate response. Fear leads to impulsive decisions. panic selling, and emotional mistakes. Understanding is far more valuable. The goal is not to predict disaster. The goal is to recognize patterns that have repeated throughout history and evaluate how they might apply to the present. Every investor, every saver, and every family should periodically ask a simple question. How much of my wealth depends on promises, and how much depends on tangible value? There is no universal answer. Different circumstances require different allocations, but the question itself is incredibly important. The world does not change all at once. It changes one decision at a time, one policy at a time, one adjustment at a time. Most people only recognize the transformation after it is complete. The individuals who navigate these periods most successfully are not necessarily the smartest or the luckiest. They are often the ones who paid attention while the signals still seemed boring, while the headlines still seemed reassuring, and while the majority remained focused on the numbers rather than the purchasing power behind them. History never repeats perfectly, but it often rhymes. Debt cycles evolve, monetary systems change, governments adapt, markets reprice, yet the underlying principles remain remarkably consistent. Wealth, ultimately, flows toward assets that maintain their usefulness regardless of political decisions, monetary policies, or shifts in public confidence. Understanding that reality may be one of the most valuable financial advantages a person can possess. In the years ahead,